Good morning, everybody. Welcome to today's live event with Andrew Wilkinson, Director of Trading Education here at Interactive Brokers, and my colleague, Jose Torres, our Senior Economist. Welcome, Jose. How are you?
Good morning, Andrew. Good morning, ladies and gentlemen. Doing great. Coming off some major elections in New York City, in Virginia, in New Jersey, as well as Proposition 50. So we're going to be talking a little bit about that, as well as government shutdown odds, as well as recent economic data and market action. How does that sound for a morning, Andrew?
That sounds like a packed agenda, Jose. Let's start with the fact the government's still closed. That means we've still got no economic data, but you're keeping yourself busy with event contracts and everything else. What is the likelihood that the government shutdown will end anytime soon?
Yeah, so right now, looking at the forecast trader tool, the 50-50 mark is between November 14th and November 21st. There's a 37% probability that the government will reopen by November 14th. That's 8 days from today, next Friday, 37% chance. But then the Friday after that, that's November 21st, the odds increase to 76%. So, the 50-50 mark is around November 17th, give or take.
So when you list all those probabilities, we've just seen with the various elections why those odds matter. Can you talk a little bit about it, say in the context of the New York mayoral race?
Absolutely. Our prediction markets, they are absolutely doing their job in terms of providing a real-time look on what the chances are of a particular event occurring. Now, for these elections that just occurred on Tuesday, November 4th, our prediction market essentially called the Democratic Party sweep across the three major elections: New York City, mayoral, governorship in New Jersey and Virginia, as well as Proposition 50 in California. And what we saw right afterwards was a significant uptick in the probability that the Democrats will have a majority control of the House of Representatives next year in 2026. So our prediction market essentially, based on 2025's results, immediately updated the odds for 2026. Of course, Proposition 50 did make it more likely that the Democrats will control more seats in California. And of course, that made its way through an impact in the House race for 2026.
And you and I have talked about that before, about how one event can have this trickle down of impact on future events. And that's one of the real strengths of the event contract. Or if you're not seeing that knock-on impact, it often means that there's an opportunity somewhere.
Absolutely. And that's really, we're seeing a lot of folks starting to respond very quickly with high conviction trades. And we're seeing folks also, the arbitrage opportunities are becoming more slim. They're not as apparent as when we first started in August of 2024. And what we're seeing is improved liquidity, faster reactions. Folks are engaging more with our markets and are able to quickly realize different correlations and are getting more accustomed with the platform, not just on their mobile app, not just in the forecast trader, also in the trader workstation, also in our Interactive Brokers desktop application. So the forecast trader is really available across all the favorite mechanisms for you to use and engage with us here at Interactive Brokers.
So now the one piece of data, one of the pieces of data that we have left concerns the labor market. Came out yesterday too, the ADP private sector employment report. Tell us about that one. We're not going to get the traditional non-farm payroll report in the morning because the BLS, the Bureau of Labor Statistics, is still closed. But what was your read on the ADP report?
Yeah, it was the first positive print in 3 months. October posted job gains of 42,000, above the expected 25, recovering from minus 29,000 in September. August also featured job losses. Now, remember, the ADP only includes the private sector. And within the report, you saw that some of the more cyclically oriented rate sensitive areas were particularly weak. You saw small and medium-sized businesses, they shed positions. It was the larger establishments with 500 employees or more that added and produced that monthly increase. Wages were pretty steady for job stayers and job changers. So that's a positive, and that's helping drive consumer spending, because wage increases are way faster than inflation, a lot faster. So you're having real paycheck growth across the American economy. And shortly after that report, an hour and 45 minutes later, you got the ISM services number at 10 a.m. yesterday, and that came in at 52.4, way above the median forecast of 50.8 and the previous month's 50. So we saw a big acceleration there. That was driven by new orders, like I said earlier, strong consumer demand, but businesses have pricing power against that backdrop. So, the prices element rose up to 70 in that same print. However, there was bifurcated results there, because in the ISM print, you had a contracting employment number, whereas ADP showed growth. So, not super confident that labor conditions are strengthening or accelerating that significantly at this juncture, but still feeling pretty bullish about the current economic backdrop in terms of the mix of consumer spending, still subdued unemployment, although hiring is slowing significantly. Strong capital markets, pro-business environment, lighter taxation, milder regulations, a reopened government soon. And that should really support markets pretty well going into 2026. Folks are worried about valuations. That's been a thing in recent days, recent months, but more recent days, more in the short term. And the way I'm thinking about it is we can have maybe 2026 or 2027, we can have a positive year, call it 5 or 6%, with 10% earnings growth, and that'll actually bring valuations lower. So you still have a dynamic where if you grow earnings 1 year faster than the stock market goes up, you don't necessarily need a correction to have higher stock prices. You just need a little bit of an alleviation from the 20% gains that we've been getting used to. We got that in 2024. We got that in 2023. This year, at the moment, we're up on the S&P 15.1%. And the futures are green right now, up around 20 bips. So, we could very well finish this year up around 20% if the S&P finishes the year around 7,100 or so. But going forward with the valuation challenges, we're probably going to be due for, a 5 to 10% year soon. That would, of course, be better than having a 15% down year or a 20% down year like back in 2022.
I want to bring this back to the platform that Mamdani ran on his successful campaign, which was affordability and attacking President Trump on not delivering lower inflation. And some of this is tied up in the tariff argument, which yesterday went to the Supreme Court. And there's, from what I can see, there was significant arguments cast against the reach of the president's power. So does this add another level of confusion? What if the Supreme Court strikes down tariffs? There's a couple of implications. One, what happens to the economy? What happens to the tariffs that have already been paid? But what does it do to the Federal Reserve's path for interest rate cuts. They've been very cautious about reducing rates because the uncertainty associated with where inflation will go as a result of the tariffs.
Yeah, so you're absolutely right. In fact, we saw a big drop in the percentage of in our contract will Supreme Court uphold Trump's tariffs by July 31st of next year. We saw this drop from roughly 44% down to the 20s. Now it's around, we had some trades pick that back up to around 28%. This was closer to 50% a few weeks ago. So, if the tariffs are upheld and they're allowed to remain, the bullish argument there is that interest rates and the fiscal situation are alleviated. But if the tariffs are reversed, then the bullish scenario there would be that firm cost pressures and uncertainty related to that is quelled a little bit. So earnings, particularly in the more cyclical areas and the small cap areas, could be more buoyant in the short run. But I think in the medium to long run, it's without getting too in the nitty gritty of the legal realm. We've been trading here in the U.S. It hasn't really been a level playing field when you consider the trade restrictions, the barriers, the currency manipulation tactics, and the tariffs themselves that other countries have been placing on us here in the U.S. for the past 20 to 30 years or so. So, I do think that the policy should remain. But, here in our prediction markets right now, it looks like the Supreme Court, right? And these odds, of course, we have a lot of time and you have a GOP appointed majority in the court. But right now, it looks like the momentum for the tariffs to maintain is certainly ebbing.
What's the time frame on any of that? The legal ramifications here, Jose. When would they retire and debate, and when would they likely make a decision? You just mentioned the upholding the contract. There was what was that? Did you say that's June next year?
That's no, July next year, July 31st.
Right. So is this likely to drag on until that point, or would they make a decision this year, for example?
I think it's going to drag on a little further. I think it's going to take some time. It's a highly controversial and highly political decision. So, typically when you add that level of complexity, the time frame is augmented. But of course, that's not really, I don't lack experience to really give you a specific time frame. But if I had to guess, folks, it's going to be longer rather than shorter.
All right. So last week, the Federal Reserve did cut interest rates by 0.25%. But given the uncertain outlook, Jerome Powell, the chairman of the Fed, and subsequent members of the FOMC have basically said that it's not a done deal. It's not locked in that we get an interest rate cut again in December, right? So what are the odds looking like now? And what did happen to the forecast odds on that contract?
Yeah, so the December contract, has been much more hawkish. The odds are up at around 87%.
Maybe you can enlarge the screen a little bit there.
Oh, make it larger?
Maybe full screen?
Okay, full screen.
There we go.
All right. So, yeah, so we were getting really dovish towards the end of October, but then we started becoming much more hawkish. Now we're standing at a 69% chance that the Fed will lower in December. Previously, it was a lot higher. And, Andrew, what's happening is that inflation is too strong. It's CPI is at 3%. As far as the Fed dissenters, the last meeting in October, we had Governor Stephen Miron opt for a 50 basis point reduction instead of a 25. He formally dissented. But we had another member of the committee that favored no change at all. And, Chair Powell's term is up early next year. So folks are really wondering what kind of, if any, biases will come from the new chair next year. But overall, it's a bullish environment for equities, particularly, not necessarily for fixed income, but for equities, because you have central banks, not just here in the States, but all around the world. In some parts of the world, they're cutting with inflation way above target. So that implies that despite the price pressures running hot, the central banks are tolerating price pressures way above their targets. Stock prices and earnings, folks, are priced in nominal terms, not in real terms. So inflation being higher drives all the numbers on income statements higher, all else equal. That's revenues, earnings, etc. So that monetary tightening that you got in 2022 that really startled risk assets, it doesn't look like we're going into that kind of episode again. And also, inflation is not where it was back then. It's not at 7% or 6% or 8%. It's at 3%. So if the Fed were to cut in December, and then inflation, let's say, would go to 3.1%, 3.2%, or 3.3%, then they would not look like they're doing a good job cutting that aggressively into rising inflation. Unless, of course, they're caught like the Bank of England, where job numbers have been awful. So the Bank of England essentially is sidelining its inflation mandate in favor of its growth, prosperity, and employment goals for the time being.
Yeah, I get the impression that's certainly going to win the day over here. It's as Steve Sosnick keeps telling us, Jerome Powell's gone with that argument that, hang on a second, yes, inflation's up here, but employment is clearly coming down. And we have to address that as part of our dual mandate. So I think that's what's winning today. And, a single quarter point cut to me doesn't really do much. I think that really is the beginning of the path of a reduction in interest rates. So, I can see the futures market and the forecast market is pointing to this being up in the air for December, but I'm fairly sure we're still going to get one. I wanted to ask you about something else. And maybe okay. So for the audience, please do submit your questions on X and LinkedIn for Jose, and we'll address those as they come in. And I was going to ask the audience a question. So Jose just mentioned that that Jerome Powell's term is coming to an end at the beginning of 2026. Who do you think is going to be the next the Trump appointee? I think we talked about this one last time, Jose, but maybe you can bring onto the screen the odds of the next chairman of the Federal Reserve.
Absolutely. And then we also have a list of questions from our InvestMentor. So we're going to go and dive into some of those questions after we cover the Fed chair nominations. So we have Hassett at 44%, Waller at 17%, Warsh at 13%, Besson at 3%, Bowman at 6%. These 5 don't add up to 100. They fall short. So if you were to buy yeses on all 5 and just one of them were victorious, you would earn a return on that investment.
I'm just trying to see those odds. So, what? Not confusing me, but I'd have thought Stephen Myron would be in the running. No.
There's an expectation that he's gonna be going back to the White House. But yeah, he hasn't been mentioned as a top candidate for Fed chair, or even a candidate. He hasn't been mentioned seriously in the mainstream as being a potential candidate for Fed chair.
Gotcha. Just still wondering from the audience perspective, who you believe is going to be the next governor at the Federal Reserve. Jose, tell us a little bit about InvestMentor.
Yeah, so InvestMentor, it's a terrific program that we're running here at Interactive, and essentially it offers younger folks, folks that don't have much experience, they're younger in their career in investing, and it offers them educational basics on the mobile, on the website. You know, we're huge into education here at Interactive Brokers. We have the IBKR campus, we have podcasts, we have market commentary, we have webinars, and InvestMentor is a new tool that is going to enable a lot of our younger investors to start learning about stocks and bonds and the yield curve, futures, options, et cetera, and et cetera. And what we're doing is we're partnering with our InvestMentor team so that their users can ask us questions here and we can offer them some additional insight. And the first question, Andrew, is I want to trade automatic with Interactive Brokers. How do I do that?
Well, define automation.
We got to build a code, you know, where essentially you tell the system what you want it to do and how much of you want it to buy or sell, and engage with which particular tools we have, and we have thousands of them. But you know, that's learning how to code and learning how to integrate that code with the Interactive Brokers platform, whether that's, you know, Python or SQL or anything like that. You know, that would be a good way to get started. What would you add to that, Andrew? I know you're an expert here.
Couple of things. Yes, you're quite right about the API route, but you need to know something about API. But you could certainly build a program that would allow you through the IB gateway to connect via API using a variety of those API methods to help you trigger an order. That's certainly doable. There are other third-party softwares that do connect to Trader Workstation, but again, these are for people who already know how to program. There's no real shortcut to making a trade occur if you kind of don't know the universe in which you're working. We did launch a couple of things recently, connections and investment themes, and we're putting together some videos for Traders Academy on the investment themes so that you can type in a theme, you can type in a company, and the investment themes role is to show you all the companies involved in that investment theme so you can learn more about it, or which companies are most exposed to it. So you type in AI, you type in oil, and it will give you those companies that are exposed to the theme, and you can learn more from that. But you know, everything here, we're self-directed. We try and make fantastic tools for the audience, and they're all there for free. But there's no such thing as being able to say, just go and do this for me. You've got to have an element of driving what's going to go into your portfolio, and some of that is driven by your willingness to learn or understand the market.
And just a quick segue, this is the InvestMentor app available on App Store and Google Play. Finance but fun, financial literacy, practical knowledge, bite-sized lessons, interactive and fun, personalized learning journeys, etc. So we're going to keep answering more questions from our InvestMentor group. And the next one is, why does inflation sometimes stay high even after central banks start raising rates? Well, because monetary policy operates with long and variable lags. So once a central bank starts raising rates, it takes a while for that to filter through the economy. So inflation may already be picking up momentum and have significant momentum, but central banks haven't just started raising, for example. So the momentum and the forces of that tightening haven't hit yet, but prices are still, ramping higher. That generally speaking, that's the most probable case. But of course, you could have shortages. You could have economies that are prone to commodity price shocks, for example, and other externalities that could drive inflation higher, even with central banks raising rates. Brazil still has high inflation, and their rate is at 15%, right? So those things happen, particularly in countries that are more vulnerable to the commodity price cycle, because those cycles could be very violent. So yeah, absolutely, central banks raising rates does not guarantee that inflation will come down, albeit it is the popular mechanism to deal with rising price pressures. Why are egg prices exploding? Well, that they've been quite volatile lately, and it's really been a supply and demand story. There's been some issues at the farms with the yields and some sicknesses affecting some chickens. And that's negatively affected the supply of eggs, driving the prices higher. But we have these months where the supply recovers significantly, and then egg prices go lower. So for the egg bears, there's a lot of hope out there. How are consumers able to take advantage of free trade and protectionist policies? Okay, well, you take advantage of free trade by essentially, when you're buying goods, you have a wide selection of products to choose from. So you try your best to analyze the cost and quality dynamics of each product. As far as protectionist policies, you could produce goods in a local market where you're protected from importers, and that could maximize your revenue. On the free trade side, of course, you can also produce goods or services and sell them freely in many markets. So that's how you can benefit from free trade. From protectionism, you'd benefit from producing goods or services in an area that's protected from imports. As a consumer, you benefit from free trade with more options. Yeah, those are some areas for folks to think about. Consumers benefit from protectionist policies. That's a tough one, but they could via lower interest rates. So the way tariff revenues are driving down the cost of capital at the long end, that's a way for consumers to benefit from protectionist policies indirectly. So if the fiscal situations are improving and you have lighter financing costs, and that helps consumers with home purchases, durable goods purchases that are usually relied on, financing is usually relied on to close those, as well as automobile purchases. So anytime you're looking to borrow, protectionist policies, assuming that they bring down interest rates, that would benefit them. Do banks favor a higher CPI because it increases demand for loans and raises interest rates? That all depends, because if banks have a lot of duration on their balance sheet, or they have a lot of long-term loans in a low CPI environment, but then the CPI ramps up and interest rates increase, then those assets are worth a lot less. So banks, it all depends on each bank, but generally speaking, banks benefit from traditional banks that borrow deposits and lend those deposits for a spread. They benefit from a steeper yield curve. So essentially, if short rates are at 3 and long rates are at 5, then that 2% differential gives banks a lot of wiggle room to borrow deposits and then extend loans with margins. So that it all depends, really. If you don't have any long-term loans, then generally speaking, you would want higher interest rates, because you would collect more on your money market funds or your T-bill-like instruments. And last question, how will AI and automation shape the job market in the next 10 years? Tough question. But I think it's going to create a lot of new jobs. I think we've been in this labor quality issue for a long time, since 2016. Right now, employers are seeking AI to perform a lot of entry-level tasks, just because the jobs that employers want prospective employees to fulfill, the economy doesn't have that capacity and hasn't had it for quite some time. So there's been this mismatch between what employers want and the skills that employees have, and AI is helping to bridge that gap. Of course, the hope is that in the next 10 years, AI will create a lot more new employment opportunities and grow profits strongly, so that capital markets, but also households, can be in a strong shape. And that's it for our InvestMentor questions. We tried to get through those pretty quickly. Andrew, how would you like to finish up? We want to talk a little bit about the S&P and bond yields and what's happening in that, and the dollar. The dollar has been rallying strongly.
Yeah, you've just mentioned a lot of things. You mentioned the InvestMentor. In the comment section of today's stream, our viewers will be able to find links to the InvestMentor, investment themes, forecast trader, and so on. And please keep on sending your questions in for the team here. Yeah, we've had a bit of an upset in the stock markets. I think the major catalyst to me, Jose, was some investment conference which was well publicized. The media was all over it, in which several bank leaders were asked a question. I guess they were on a panel discussion, and they were asked the question: is there a chance that valuations are frothy, that there's going to be a correction, and how much will the correction be? So that seemed to me to be behind Tuesday's risk-off day, and then again yesterday we got 50% of that back. What are your thoughts on the stock market at this point?
You have a lot of supporting factors from Washington, Capitol Hill, but also the Fed, the White House, and you have inflation running faster. So I'm still bullish. I don't think that when you look at the Treasury's composition and the deficit situation that we're in, which is improving, by the way, it really can't sustain lower stock prices over time, because tax revenue would be dented too greatly. So just when you consider that, and you consider the fact that we're expecting double-digit earnings growth next year, I don't really see a significant correction or pullback happening. We could go down maybe 10%, but I think that all those spurts of volatility would be buying opportunities. I'm not saying we're going to go up 20% every year like we've been performing, but I do think that it's one of the best, but in my opinion, the best asset class to be invested in right now is equities, just because they're resilient to inflation, they're resilient to higher interest rates, they're even resilient to shifts in the economic cycle. So I'm still, even though we're trading at almost 23 times forward earnings, I still think that over the next few years, we can still advance. We can still have rising stock prices. Maybe we go up 8% or so, or 7%, while earnings grow 12 or 13. And that'll be enough to get the forward P maybe down to 20. Or the other bullish case is that the stock prices and the valuations will continue expanding concurrently, because the valuations have been on an upward trend over history as companies have become less sensitive to cyclical changes, less sensitive to interest rate moves, and participation in the stock market is through the roof. When you consider every 2 weeks, folks are contributing into their 401k accounts, and just all the different buying activities that occur, mutual funds, pension funds, individual day traders, et cetera, and et cetera. The system at this moment doesn't seem like, it could withstand a significant correction or so. So I wouldn't worry about what the Wall Street CEOs are saying at the Hong Kong summit.
No, me neither. So what is the forecast contracts for the year-end value of the S&P telling us at this point?
Let's go to Chief Strategist Sosnick real quick, and then we'll go on to the S&P.
Okay.
Hi, I'm Steve Sosnick, Chief Strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy yes or no contract on Forecast Trader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose Interactive Brokers.
And right now, there is a 47% chance that the March 2026 E-mini S&P 500 futures would settle above 7,000 at year end. 47% chance. This was a popular point of discussion yesterday during our Forecast Trader Roundtable, which we're doing every couple of weeks or so. Essentially talking to different market experts from different parts of the industry, and they're talking to us about their views on prediction markets and specifically within our landscape, which instruments they like. Yesterday, we had the pleasure of welcoming Harry Figge and Denton Jones of Greenwich Wealth Management. We had Mike Larson of The Money Show, Jeff Zipper of Fifth Third Private Bank, and Vincent Rendazzo of Viewpoint Advisors. And they really, podcast isn't published yet, but it'll be published soon. And I welcome all of you to go check that out. We have some research analyst experience in that group, economist experience, of course. We had wealth management folks from Greenwich Wealth Management and Fifth Third. And, really interesting, the insights they had on prediction markets and how it's an uncorrelated asset class that can protect against particular eventualities. For example, in 2023, when inflation was coming in at 5%, 4%, 6%, and folks maybe positioned bearishly on equities because they said, oh, higher inflation, oh, Fed is tight, let me short equities, or let me short treasuries even, they'd find that stocks and treasuries would rally after some of those prints because of perhaps oversold conditions or technical issues or whatever. So even though they got the inflation call right or the Fed call right, whether steady or cut or hike, they still lost money because that trading decision didn't work out the way the investor thought a hot CPI or a cool non-farm payrolls would generate shifts in the stock prices or treasuries as they expected. Prediction markets solve that problem. Of course, liquidity is growing and it's going to keep growing. As it keeps growing, that really solves the problem of, a hot CPI may dent my portfolio because of folks can just come in and quickly hedge on, if you're scared of a hot CPI, buy yeses. If you want if you're afraid of a cooler CPI and softening economic conditions, perhaps, then you can buy no contracts. And those insights were particularly helpful.
Very good. Jose, been a great discussion. Thank you to the audience for showing up, and thank you for taking the time this morning.
Absolutely. Thank you, Andrew. And just to highlight, we on forecast contracts before we go, 12.68 million contracts traded on election day. Weekends have been particularly active. Last weekend, we saw over 2 million contracts traded. This week has been very active. So, those folks that may be our customers or considering being our customers, but maybe don't want to engage much in prediction markets, we invite you to come in and check it out. We're a growing company, customers, assets under management, stock price, all that And we want new growth verticals in our firm, and forecast contracts are one of them. Over 8,000 instruments, quarter over quarter trading volumes up in above 100%. So, we want you to come in and see what we have here at Forecast Trading. We'll be back next week, Andrew and I. And then I'll also be with Judith Casasampere next week, Espanol. So we look forward to continue doing these live events. 3 per month is the frequency for now. 2 in English with Andrew Wilkinson, 1 in Spanish with Judith Casasampere. Thank you all for joining us, and we will see you all next week.
Thanks, Jose. Bye for now.